Now I spit a 16 straight with no punch. Remember?
Hey guys, how are you? Welcome to the podcast. I have on someone who's a really cool guest today, a good friend of mine, Brian Boyd. Brian is a financial planner extraordinaire in the Sacramento, California and Bay Area. He runs Boyd Wealth Management, LLC, his own firm, and deals mostly with high net worth individuals. But he has some really good information for everyone today. So I'm excited to have him on, and he definitely gives some sage advice. Thanks so much for listening. Today I have an awesome guest, a good friend of mine, and Brian Boyd of Boyd Wealth Management. Brian was actually very elusive to get on this podcast. I had to chase him down for about a year and had to track him down because he's a superstar. But thank you, Brian, for finally coming on, huh?
Yeah, it's great to be here. Good to see you live. You know, we talk a lot, but it's good to see your face.
Yeah. You too, my brother. And hopefully one of these days soon, I get out there to Sacramento to pay you guys a visit when the zombie apocalypse calms down a little bit, huh?
One of these days, we're holding out.
Yeah. Well, Brian, of course, we're going to dig deep into the whole mechanics of your business and being a financial planner and wealth strategies and what the average person maybe could do that the wealthy already know that they should do. But first, why don't you tell us a little bit about yourself and your background?
Well, my background is pretty interesting. I grew up in the Bay Area, and I was one of those kids. My parents would give me $3 for the arcade, and I would pocket $2 of it in my piggy bank. So I maybe inherently grew fond of saving at an early age, and I had a paper route, which unfortunately doesn't exist anymore. I'd love my kids to have a paper route, but it was the best job going. And so I loved having my own money and the responsibility of working. And then when I was 16 years old, my mom drugged me down to the bank to open up my first individual retirement account.
Wow.
And yeah, so I had great role models, and I also had an inherent desire and maybe understanding of money. And so I had worked that whole summer as a gas station attendant. This is back in the day, you know, when we had gas station attendants that would pump the gas for you.
Yeah.
Windows, check the tire pressure. I raked bunkers at the local golf course. And so the whole summer I'd accumulated probably $2,000. And my mom, as I mentioned, drugged me down to the bank and made me put the whole $2,000 into an IRA. And I was kicking and screaming. I was furious about it. And then the next year, she did the same thing.
Yeah.
And I wasn't as mad about it because I had seen the balance grow and kind of really enjoyed seeing that. And so that kind of started my love for finance. So I moved from the Bay Area to Sacramento to go to the prestigious Cal State University of Sacramento.
Okay. Now I didn't know that's why you came up to Sacramento. So what was it about Sac State that attracted you? Was it like your basketball scholarship or something like that, or, you know?
Yeah, 5 foot. Are you talking smack?
Of course.
5 foot
Of course
7.
I'm talking smack.
So the basketball scholarship fell through. So I was the first person in my family to go to college.
Kidding.
Looking back, I didn't really understand, you know, the whole process. And so getting into a state school really seemed like the easiest. You know, you take an SAT and so I applied to a few state schools, and Sacramento, frankly, was far enough away, but still close enough to home. So that was very appealing. I had a couple friends a year earlier who'd left the Bay Area and gone up to Sac State and had a great experience. So that's really what drove it. And they had a great business program. And
let me ask you this, if it's okay, Brian, because this is interesting. So you were the first one in your family to attend college. But even at a younger age, like as a teenager, your mom was trying to teach you financial principles and, you know, probably budgeting and saving and, of course, investing, which you don't usually see, right? That's not usually something that people who don't have a college education really have the highest acumen when it comes to saving and financing. So was she trying to prepare you for the world? Was she trying to equip you better than she had been equipped, or where did that come from?
I think so. I think my parents both worked, and they both worked really hard, and to keep us in our middle class household and all the stuff the kids want to do. And so I think, like I want for my kids, they wanted a better life for myself and my brother. And so they were just really good with money. And I think that's an important ingredient, is having good role models for money. And they were fantastic role models. And then I inherently fell in love with it because of that. I was very lucky in that I found my calling, at a really young age.
And that's so true, because if kids don't have role models, if they don't have financial education, they don't even teach it in high school and middle school, probably even in college these days, like credit, how to balance a checkbook, save a third, spend a third, whatever these rules are, even the basics. And it's, we could get into conspiracy theories, but it's probably they want people to be uneducated about finances so they're better consumers and they, make bad choices. But if kids have that early in life, they are so far ahead of the game, huh?
I agree 100%. And then the whole game is compounding anyway. So you have good habits and start those habits at a young age, and it absolutely explodes from there. Yeah.
Fascinating. So you were up at Sac State, and Sacramento wasn't as big and metropolitan as it is now. It was probably more of a college, a smaller town or a smaller city then. But you were in the business program there, huh?
Yeah, it was still very much a cow town when I moved to Sacramento, but I really hit it at the perfect time for, my career path. The growth trajectory of Sacramento and the Bay Area transplants.
What year was this? Like 1984 or something?
I don't want to tell you. It was 1992.
Okay. Yeah, you're younger than me, brother. You're younger than me.
Yeah, so I graduated from Sac State in 96 and with a degree in finance, because I knew, I wanted to go help other people do what I had been doing for several years. And it doesn't mean I wasn't broke in college, right? I started very, very modestly, but I started with really good habits.
Yeah.
And so I said, I want to go help other people do this. And it was very difficult. I mean, this is not an easy business to get into. Cold calling and, knocking on doors and lots of rejection and
especially when you're young, right? They're looking at you like, why would I give you my money? I mean, it's a huge barrier until you get a little more seasoned, huh?
Credibility, knowledge, value, like it's just very, very difficult, but it's been a fantastic career, and it's, we're 25 years or so into it, and now on the other side, it's really been fantastic, but it can't be understated how difficult it is to start in the financial services industry, even today.
So out of college, what firm or what company did you start with, or how did you get started?
So I started as an intern while I was still in college at Northwestern Mutual, and they were just transitioning from a pure life insurance company to also a holistic financial planning firm. So I was really attracted to that. They had a great training program. You got to learn to sell if you're going to do anything, right? And that's not a bad word. You have to sell yourself, sell your services. So I had built a substantial business over the years. And finally, in 2018, my partner Ryan and I launched our own firm. It was just time to do things our way and build an independent, fiduciary-based financial planning and investment management firm. So we launched in May of 2018, what is now Boyd Wealth Management. And that's kind of been our trajectory.
Yeah, that's fantastic. And I remember visiting you when I first got to know you at the old Northwestern Mutual office, I think, when I first came and saw you at some point. So it's fantastic that you have Boyd Wealth Management. Has your Boyd Wealth Management, do you have a different target client or a different population that you serve, a demographic that you're after?
Yeah, we're definitely a full services financial planning and investment management firm. And so that means we typically cater to people who have really complex financial issues, right?
Okay.
So if you think of one spectrum today, you've got, it's really, you and I have talked about this, it's the golden age for individual investors, right? Between, Vanguard started this movement years ago, the democratization of investing, right?
Yep.
So if you look on one spectrum, there's so many do-it-yourself options between Vanguard, Betterment is a great robo-advisor platform. Like there's no excuse not to get started investing now, right? On the full, and then there's some things in between, but on the full other end of the spectrum is I really want somebody to do all of this for me.
Yep.
And I need sophisticated, ongoing advice on every decision I make. When I go to buy a mortgage or I want to buy a building, how does that incorporate into my financial plan?
Yep.
I want to have enough to retire comfortably. I'm thinking of selling my business. Will I have enough with the proceeds, net of tax, to live the life that I want to live? And then managing those investments to a very specific plan. Mm-hmm. So there's kind of general democratization. We're on the other side, full service, and we charge for that. I mean, we're like a family CFO, if you will. Today we serve about 80 families. So
to use an analogy, like you could go to Supercuts and end up all jacked up like this, or you could go to Kevin Michael's salon and end up with beautiful coif like that, right?
That's right.
That's the first commercial there that we're going to drop in there. That was Kevin Michael's salon. So I'm going to hit him up after and try to get a couple bucks,
Yeah, get sponsorship.
But it makes sense. And I know when we talked a lot about it, like you said, it's complex financial and comprehensive financial planning. A lot of people who are a business owner, and what's their strategy? What's their exit strategy? You talk about that a lot. How do you actually pass the business or the wealth to the next generation without it eroding? And then, of course, you incorporate the complexities of a CPA or tax advisor, and possibly even, if they have an attorney or legal issues, you guys work as a team to make sure they're all set, right?
Yeah, that's great. That's a good point. That's part of the full service, right? We pretty much know all of our clients' CPAs, their estate planning attorneys, maybe their M&A attorney.
Yeah.
We're working collaboratively with the other advisors to make sure that the client has the right plan. We don't know everything. And really the other advisors don't either, and they'll readily admit that. So we all work together to get the most optimized outcome.
Yeah, that's fantastic. And I know a lot of your clients, your book of business has really grown, and it's not because you're, out there really soliciting. It's just because of who you are, and you're transparent and you tell the truth. You put it all on the table. You don't pretend to have magic tricks or a crystal ball. And so tell us a little bit about your personal or Boyd Wealth Management, some of your overall guiding philosophies for investing or planning.
I think there's, just a few principles from an investment standpoint that everybody can follow. And I think the underlying principle is the world is very complicated, and CNBC would want you to think that this is extremely complicated. And it's really not. It boils down to doing, just a few things really well. And the first is, if you're going to start investing, really determining how much risk you're willing to take in order to meet your objectives, right? And everybody talks about the stock market, right? When you're investing in stocks, as an example, you're buying ownership in quality companies. Mm-hmm. Or you're buying quality ownership in junky companies.
Yeah.
How you go about it. But you're an owner. That's where the risk is, right?
Yeah.
Is this company could fail. This company could do exceptionally well, like Amazon. And so that's the risk. You're last in line as a stockholder, just like any other owner, to get paid. But at the same time, you can have incredible appreciation on your investment as the value of your ownership grows and or the company spits off distributions in the form of dividends. So that's really the risk when everybody thinks about that. And so on average, since 1980, at some point during the year, if you look at the US stock market, it's down about 14%. There's a 14% peak to trough drawdown at some point on average in any given year.
That's pretty damn significant.
Yeah.
Yeah.
It's hard to imagine and the reason is because most years still end up positive.
Yeah.
So the vast majority of years still end up positive. And then you also, as a stock investor, have to endure every 5 or 7 years a 20+% correction, right? So you're watching your capital kind of evaporate and recover on a regular basis. And so really that's why the first step is so important. How much of this nonsense am I willing to endure in exchange for higher returns? Because stocks historically have also produced the highest return, but you have to put up with the nonsense.
Yeah, and it seems like with the risk, people are their own worst enemies. And we talked a little bit about this via email. We all know buy low, sell high, right? But people tend to do the opposite based off fear. Greed is a big one. If the herd mentality. So that's why it's great to have an advisor that's really doing it for you, to basically take your bias, to take your emotions out of investing, correct?
We try.
Yeah.
It's really hard. It really is. That's why, just talking about percentages is tough too. We've shifted from percentages to dollar amounts when talking about these drawdowns too. Because I really believe in talking to somebody, anybody can take a 20% drawdown. But if you think about $1 million portfolio, that's $200,000. You have to be ready, investing in stocks, to see that or more temporarily evaporate off of your statement every 5 to 7 years. In fact, the average bear market has been, I think, a 47% drawdown, right?
And so you actually do that with clients where you say, let's switch from percentages to talking about dollars, just so that, to wake them up that, hey, we're not talking about monopoly money here, huh?
Yeah, I think it's a whole different conversation that gets to the heart of how much risk am I willing to take. And so that's one spectrum, all stocks, right? I'm going to take this ride and I'm never going to look at it, and I'm going to turn off the news, and I'm just going to ride it, and I'm going to take these huge drawdowns, but I'm going to get the benefit, hopefully, of the return in the long run. There's no guarantees, but historically that's been the case. And then at the other end, I never want any of that risk, right? And so that's cash, right? You're putting it in FDIC, insured savings at the bank. The problem with that is you're never going to outpace inflation, right? You have the silent risk, if you will, which is inflation is actually eroding away at your capital, such that $1 today is worth half as much in 20 years. Mm-hmm. So you stepping off that curb, right? Mixing, how much can we mix between stocks and bonds and cash using modern portfolio theory? I mean, Harry Markowitz won a Nobel Prize for this in the 1950s. But how do you combine then assets in such a way that you can maximize return for a given level of risk? All the way from I'm a 10 out of 10 on the risk scale to I'm a 1 out of 10. And if you can kind of nail that down and you know what you're getting into, and you can kind of look at some historical, how has this portfolio performed under different environments, then you can be healthy in making a decision for yourself on how much risk you're willing to take.
That's very interesting. And with risk, of course, one of the key conversations you have with your clients is, I think you told me, look, we may underperform some of your friends and golf buddies who have this hot stock and who have this, they're riding the wave when everything is going great and the market's rosy, but we're going to protect the downside a lot better and you're not going to lose as much, correct? And so is that part of your advice to them or your philosophies?
Yeah, it really is. Downside hurts more than upside helps. If you do the simple math, if you invest $100 and you make 50%, you're up, you have $150, right? If you lose 50%, you have $75.
Mm-hmm.
So your average return is 0, but you're actually down 25%.
Wow. Fascinating.
So that's why downside hurts more even than upside helps. And then you throw the emotional component. Studies have shown actually that humans react way more negatively to losing than they do positively to winning.
Mm-hmm.
So that there's psychology in it, but there's also, that's the basis of modern portfolio theory, right? Is maximize return for a given level of risk. And that's where diversification comes in, right? Not putting all of your eggs in one basket, owning stocks and bonds from different industries, stocks from different companies, different countries.
Different sectors, right?
Different sectors, they perform at different times. And it's extremely unpredictable when something's going to perform. I'm fond of saying diversification is the worst form of investing, except for all the other ways.
That's great. I love that. Yeah, you told me that the other day, and that's just the absolute best saying,
Yeah, because you're always, something in your portfolio is always underperforming the best performing asset in the portfolio. And regardless of what media will have you believe, it's impossible to predict when that shift is going to occur. So that's part of the psychology too.
Let me ask you about that. Let me ask you about that because it's impossible to predict. So there are so many people in the U.S., with their fancy suits and their 3 martini lunches, and they're on Wall Street, and they talk about how much they know, and they have 5 monitors watching stocks go up and down and information, but no one knows what's going on, right? They make money off of fees, correct? So basically these people, if anyone tells you they know what's going to happen in the economy, they know what's going to happen in the market, they know what's going to happen with a company, it's completely erroneous, correct?
Correct. Nobody I've ever found can do that consistently. You can kind of get lucky once in a while. There's been some cases of some people calling the financial crisis, but their track record even since then has been horrible.
Yeah.
And so it's just really, really difficult to consistently predict what the economy is going to do. And the economy is not always the stock market either.
As we see now.
You can have perfect knowledge of the economy or even a individual stock's earning report, and you still don't know how the market is actually going to react to that news.
And we're seeing that now, of course, and maybe at the end of this podcast, we'll talk a little bit more about our current circumstances in the economy. For people out there watching or listening, we're filming this in December of 2020, and in an unexpected twist, Kanye West is now the president of the U.S., right? No. It's July. It's still July. We don't know anything about who's going to win. But talk to me a little, Brian, about, you wanted to shed some light on some of these principles that possibly wealthy, ultra wealthy people, families that control and continue their generational wealth. What are some of these basics that they understand that maybe the average person doesn't understand?
Well, so I think, continuing what we talked about, it's if you're going to invest your money, you got to have a plan.
Yeah.
And when you know that the S is going to hit the fan at some point, you just go back to the plan.
Yeah.
So the plan is, what is my risk reward scenario? What is my diversification strategy? Which, by the way, the average investor can do a risk profile questionnaire online now.
Mm-hmm.
They can go deploy that strategy with a robo advisor. You don't need to pay a lot of money to get that done. You rebalance that portfolio at regular intervals, right? So a 60% stock, 40% bond portfolio in January had probably become a 40% stock, 60% bond portfolio by March 23rd of this year due to the COVID downturn. Now, you would want to rebalance that portfolio back to that 60% stock, 40% bond weighting. It doesn't mean it feels good to do that. You're buying stocks in a terrible environment, but look at the other side of it, right? Stocks have rebounded sharply, not because you were making a market timing call. We didn't rebalance for our clients on March 23rd. We were a couple of weeks early, but we weren't trying to time the market.
Yeah.
Our portfolios have gotten out of weight, and so we just simply move them back. Now, when the stock market does really well, you got to rebalance back the other way, right? You can go from a 60 stock, 40% bond portfolio to a 70 stock, 30 bond portfolio in a hurry. And you want to let your winners run, but you can't do that too, right? You set some thresholds in there. And so you're not now taking on too much risk when stocks are doing better. So
it's basically bumper bowling, huh?
Yeah. I mean, but that's all you should do to your portfolio, right? And then look out for taxes. Everybody wants to trade. How can I trade? All trading does is cause you to recognize capital gains taxes, right? You want to be in tax efficient investments for the most part, like exchange traded funds, which again are widely available. They have significant tax advantages. Again, if you're not for assets that aren't in a 401k or an IRA that are inherently tax deferred. So keep the taxes down. And then most importantly, don't mess with it.
Mm-hmm.
Right?
That's the hard part.
It's the hard part.
Yeah.
And you had a great post the other day just about how humans react under stress. And I was reading it, I'm like, check, I do that, check.
Yeah.
Check. And I'm no different than anybody else. I still get anxiety when we go through these downturns. I'm not bulletproof.
Yeah.
But I have a plan for myself and my clients. And so that's what gets us through. And we don't deviate from it.
Yeah.
And it has worked. That this plan has been proven to work historically. So.
And one thing that you mentioned is it's a misconception that financial planners or experts or whatever are timing the market, right? That really doesn't exist. And talk a little bit, you've taught me that basically some of the biggest upswings in the markets come very close to the biggest downswing. So it's next to impossible to really time the market efficiently.
Correct. So the answer to your question is yes, there are advisors that attempt to time the market, but they don't do it successfully and certainly not consistently over a period of time. And if it worked, we're very evidence-based investors. If I could find a system that works to get my clients out before the 30% drawdown and get them back in at the bottom, I'm going to do it.
Yeah.
There just is zero evidence that you can actually time that correctly. In fact, more damage is done trying to do that than actually doing it. And part of the challenge is, as you just mentioned about the good days and bad days, is there's so many false positives where the market does a 5% head fake in 3 days. And then you go, oh, this is a 30%er only to rebound. You can get whipsawed And I mean, how do you know that the first 5 or 10 or 15% isn't the end? How do you know the 30's not? You just can't, you don't know where the bottom is. There's way too many factors to deploy. And so market timers, where they get into trouble, Morningstar did a study, which we posted in our blog during the whole Corona downturn, was, if you looked for the 20-year period between 2000 and 2019, if you just stayed invested in the US stock market, forget about bonds for a second and cash, you just invested in the overall market, your average return was just over 6% a year.
Okay.
If you had missed just the 10 best days because you were goofing around, your return was just 2%.
So
10 days out of 5,000 trading days, and your return was absolutely decimated.
10 days out of 20 years, and it's the difference between 6% average return and 2%. That's insane.
Yeah, and those stats are straight from Morningstar. And to your point, the best days were clustered around the worst days.
Fascinating. That's fascinating. You talked about how, of course, you have these same, you're not bulletproof, you freak out a little bit. Maybe that's not the right term, but when the markets, do you have, as a planner, do you have some really, really tough days when you just look at you wake up and turn on the news and go, oh shit, it's going to be one of those days, and you're just waiting to get beat up on the phone all day long?
I do. I mean, personally, I take it very seriously, particularly my responsibility to our clients, and even my own portfolio. I don't react to it, but it's not comfortable. I wouldn't say I freak out, but I'm with everybody else. It's very uncomfortable to see sharp declines in the market, but it's what you do about it or don't do about it that matters the most. And so we've come to a place, you mentioned about phone calls. So because we're really, really clear on the front end, here's how we manage money. Risk profile, diversification, long-term, rebalance, manage the taxes, keep your expenses down. Then our clients know what to expect. They kind of know now what we're going to say during these downturns. It doesn't mean we don't reach out through our blogging and through phone calls, but with knock on wood, we're really lucky that we don't get a lot of phone calls, because I think we do a good job preparing people that this is what you're getting into.
I read an interesting quote today, and God, I wish I remember who it was. Maybe Eisenhower. And it said, you only hear the word morale ever spoken when it's bad, right? You never hear it when it's good. No one talks about morale. And same thing with probably investing. When the market's great, it's expected that their returns and your management reflect that. But when it's bad, you're going to hear about it, huh?
Yeah, that's very true.
Very interesting. Talk a little bit about, because you've done some research into this that you shared, people who are business owners who built a business up. I think it was bootstraps to bootstraps in 3 generations or something, right? Was your term. Talk a little about that and how a lot of business owners really don't have a plan to pass on their wealth or exit strategy.
Yeah, so it was called shirt sleeves to shirt sleeves.
That's what it was.
It's that old saying, shirt sleeves to shirt sleeves in 3 generations, right? And in fact, I think the number is only 10% of wealth makes it to affluent wealth makes it to the 3rd generation. And so that's kind of part of the coaching that we do with clients. Our niche really is in business owners and helping them, build the business, protect the business, and then ultimately exit the business. But it's really helping them transfer their values to the next generation. By the 3rd generation, the real problem is they've lived with this wealth for so long that, and what is a family to do, quite frankly? If you have worked really hard, are you going to go to the lake house in Lake Tahoe and your kids stay at the flea bag down the street? I mean, it's just not realistic. So you have to work harder than everybody else to pass down, number one, the story. How was the wealth created? That story needs to be told ad nauseum. If grandpa came over with a nickel and a dream from Europe and built the largest refrigerator business, in town, then that story needs to be told, and those values need to be passed down. Helping kids get an appreciation for money. Even if you have tremendous wealth, it doesn't mean you have to buy your kid the best, fanciest car, right? Help your kids learn an appreciation for the money. Maybe they have to save up and you're going to do a match for their first car. I was just having this conversation with my 9-year-old the other day. I'm a little bit of a psycho. I said, dude, we got to get cracking. You've only got 7 years.
Yeah.
You start driving. And literally we had this conversation how I'm going to do a matching program. If he babysits and works at Starbucks and he earns, saves $5,000, he's going to get a $10,000 car. If he works harder, he gets a better car. If he's lazy, and he only saves $1,000, he's going to be driving a real clunker, but it's going to be his clunker.
Yeah. Now that's a great way to do it, to basically, it's still realistic. You're not, if you have some sort of wealth, you're not going to have your kids, like you said, out on the street and fending for themselves and not enjoying some of those opportunities or advantages, but you want to give them the appreciation. So it's basically the guiding philosophy of the family and their business, or even the culture of what that wealth means. Huh?
That's right. And you can help, you don't want to just use your wealth as a tool without any buy-in from that next generation. And family meetings, so we talked about the values, telling the story, but you really need to have family meetings when you have you're a business with significant wealth, or you owned a business, maybe you've sold it, but you really need to talk about here's what we believe as a family. Here are the things that are important to us. Here are the charities that we believe in. Here's the impact that we want to have in the world because of our wealth. All of our needs are met. So these things are really important to us. How do we want to live? What is this family all about? And really identifying that. And that's not 100% guarantee of success, because people are people, but it's a way better strategy than doing nothing and just handing the next generation a pile of wealth.
Yeah, it's like handing them a blank check and saying, I hope it works out. That it rarely does, huh? Yeah, very interesting. Let me ask you two things. First, I wanted to touch base on real estate.
Well, I think real estate is a great investment, but not your primary residence, right? I think just to clarify, I think most people don't look at all of the numbers for a primary real estate. That doesn't make it bad to own a house. I own my primary residence.
Of course, yeah.
I choose not to rent, but it is not necessarily a wealth building tool for me. By the time you factor in property taxes and maintenance and remodels, the rate of return on that is not competitive. Again, it's market related, where you're at. There's certain locations that will do better. So that's really been my philosophy. If you're going to buy a house, but maybe don't, at least for our clientele, don't fool yourself into thinking that it's an investment, right?
Yeah. And definitely it shouldn't be all your eggs in that basket. Like, hey, this is my number one investment, my primary residence. It's my number one investment. It's my retirement. It's the equity is, what's going to take care of me. Because as we know, that really doesn't work, huh? It
can. It's a very illiquid investment. So you'd want to have, when you want money from your house, the bank's not willing to give it to you, right?
Mm-hmm.
It's when you're having the hardest time or the economy's in the worst spot. And your audience will probably poke holes in what I'm saying all day, and I'm totally open to that. But that's just my philosophy that a primary residence. So we have a real estate sleeve in our portfolios. So from an investment standpoint, non-owner occupied, I think real estate's a great investment. We're investing mostly in REITs, right? Commercial properties and vacation or resorts and apartments and things like that. And I think the difference, so we don't discourage our clients from owning rentals and things outside either, but we definitely have the discussion about that is a little more of a labor intensive investment. Even with a property manager, somebody is still going to need to call you to get authorization, perhaps to fix the things that need to be fixed. You may go a few months without having rental income because you have a little bit of turnover there. There's just more to think about and manage with a rental property versus an S&P 500 index fund, right? It's low cost and you don't have to think about it a lot. That's not the only way to invest. It's just understanding the difference between what is involved in each of those investments, right?
Yeah, very interesting. And that's why REITs are so valuable too. You could dip your toes in real estate investing without, having to deal with, the sink broke and this renter needs to be evicted and, all this stuff. How much of your day is actually reading, studying, and what sources do you pay attention to? I mean, you're not on like CNN or something like that when it comes to economic news.
No, I usually start my day. I'm up well before the market. I'm an early riser by nature. So I'll spend the first couple hours every day. See NBC. I want to see what kind of a broad view of what's going on. What's the story they're telling my clients today about?
Yeah, interesting. Yeah.
About why things are doing that. I'll listen to a podcast like yours, or I've got a couple of great financial podcasts that I listen to. Twitter, believe it or not, for better or worse, has a great culture of great sharing of articles and posts. There's some really great minds on there. So I'll do a fair bit of reading and researching every day. And then really once the market opens, I don't really think about the market that much, to be honest with you. It's more the blocking and tackling, meeting with clients, talking about their financial plan, because what the market does today really doesn't impact the decisions that they need to make today with their money and how that impacts their long-term plan.
Yeah, that's great. It's all about that plan, huh? So you can withstand it. It's like a boat moving in the right direction. It doesn't matter what waves come in. You're going to stay on course, huh?
Correct.
Interesting. What's in the future for Boyd Wealth Management? How big, small, diversify like other locations, more advisors? What's your goal and vision for your firm?
Yeah, that's a great question. So I really like being small. We're intentionally small, which is not a bad thing. I read this great book. It's called Small Giants, and it's about these great companies that were growing really fast and made the conscious decision to stay small. Super high quality, super high focused, super specialization.
Yeah.
And that suits my personality better. I want to be more to fewer people. I don't think, you never know, but I don't think we'll add advisors. We have 3 advisors essentially on our team, but they're all, the clients of our firm are shared clients. We all work on them together. So I think, if we're at 80 families now, if on my deathbed we topped out at 200 and and we're a team of 4 now. If we had added one more person to help us manage that, and we didn't dilute our brand or our service, then that'd be just fine with me. It's manageable. It's super enjoyable, this business. I love what I do. And if I got to the point where I wasn't enjoying it, that would be really bad for me.
And it's nice because that size, you could have personal relationships with literally every one of your clients and really know what makes them tick and what they need. And so that's part of the benefit of staying that size, huh?
It really is. You know everybody's plan, you know their families, you know their personalities, you know their fears, you know what makes them happy, you know they're charitable, what those special things that drive them. So I wouldn't want to lose that, you know, and just be the CEO and run the business. I still want to see the people. I mean, it's been hard to see people other than through video.
Not a Zoom.
I still want to talk to people. I still want to listen to them, hear their story. And I think if we got too big, I would lose that. I'd be too busy running the business. And while I like that, that's not the best part of my day.
Yeah. You talked when we started this, you told me your backstory about growing up and how your mom instilled in you this discipline of investing, and also it led you to a lot of great education about investing, and your goal was really to teach others or give back what you learned. What are some projects, charities, initiatives that you're doing, educational pieces, mentoring? What are some things that you're doing to give back and to pass on that knowledge to others?
Well, it's a great question. So we're really working on right now, reaching out to this next generation of our clients, right? So as our clients are aging, we're really making ourselves available to that next generation. So helping them get enrolled in their first 401k. We're doing financial plans. We had a client's son recently graduated law school, and like, how do I manage my debt? And when should I buy my first house? And what is a 401k? So we're really helping in that regard. The second place that I think we have a really big impact is we have a significant amount of 401k clients where we manage the 401k for the business.
Okay.
So we're really big. We have, I think, over 500 or 600 participants in our plan. So we're pushing out content regularly to them. We're doing, annual education meetings where before COVID, we could go in to the conference room and really, have a presentation, but then answer one-on-one questions separately. So we're spreading the love, and the blog as an example is something that I really couldn't do at my previous firm.
Yeah.
And it was something that it's been the most challenging thing I've ever done in my life. You and I've talked about it, consolidating your thoughts into words that are meaningful, hopefully entertaining, impactful. So right now I'm focused on that as kind of my project. As hard as it is, I'm trying to get good at it and stay consistent with it, because I never know who's going to benefit from that message.
Yeah.
And I'll go weeks and I won't hear from anybody. I'll write what I think is the greatest piece on the planet and crickets. And then I'll run into somebody and they'll say, hey man, that was the perfect time for that article. I was mulling through a decision and that really helped me think about it.
And it's like ripples in the pond, because with the content you're putting out, and you put a lot of care and love into it, you really do. Because once someone starts reading it and they get some value out of it, they're going to read it again and again. And basically you're having a conversation with them or giving them tools or empowering them via that blog. But then they're going to pass it on to their children, their spouse, their coworkers. And so it does make a difference, you know? Yeah.
I think it does. You just don't hear it. And
Yeah.
so you want to have a big impact. So I don't know. I think ultimately, I'll write a book, put some of this experience in writing. I think, like I said, it's not only been a rewarding career for me, but I've practiced what I've preached, and
Yeah.
I want to help other people get that may not have access to a full service financial advisor. Like, how do you do some of these things effectively? What are some of the blocking and tackling that hasn't already been written about? So maybe you and I will partner up on a book here in 2021 or 2022. And I'm thinking about that for the future to how do I give back and have an impact?
That's great. I mean, fantastic. I absolutely love helping clients with that too. You know, the ghostwriting or it's really just staying organized and on point with writing books. But you may not realize it, but you're basically writing a chapter every week or two when you do a blog already. That's interesting. And Brian, absolutely, thank you so much for your time here. To wrap things up, I always ask my clients 3 questions, okay? And they range from serious to semi-serious to ludicrous. So if it's okay with you, I have a couple questions to shoot out to you here.
Can't wait.
What was your first concert you ever attended?
Oh, that's an easy one. AC/DC, Cow Palace.
Okay. What year was that?
All right, I'm going to guess the year was 1990.
Okay. All right. Were you dressed head to toe in like the jeans jacket with the bedazzling and all that stuff?
Probably not, but I did get a little bit of trouble. I kissed a girl who had a boyfriend who was much bigger than me. I made a big mistake that night, so that's why I remember it so well.
So what went down with that? Was he chasing you around the concert?
It was a lot of run. It happened weeks later. He found out it was a lot of me running away.
Nice. I like it though. I like it. You got to make it memorable.
It was very memorable.
How about this one? A golf game for $1 million versus Udi Carrasco. Who wins?
Oh, if he uses his handicap, his fake handicap, he definitely wins. If we play straight up, I think I got him.
You smoke him, huh?
I think so. He's a good golfer, but I think I might edge him out.
Nice. I like it. And last one, how about this? This is a little more serious. What advice would you give your younger self? Like if you were just coming out of college or just starting in the business?
Well, I think it's a good question. It's something I think about a lot. I think I would just tell my younger self, everything works out. Just do the plan, work hard, do the right thing. Don't stress, just keep doing that. Like everything's going to work out. You're going to accomplish all of this stuff. It doesn't have to happen right this second. Just slow down, enjoy the process a little bit more. You'll get there eventually.
That's wonderful advice. Yeah. Brian, if someone wants to get in touch with you, if they have questions, maybe they want to put their money under management with you, what's the best way for someone, or read your blog? What's the best way for someone to follow you?
Well, you can always visit our website. It's boyd-wealth.com. You can also sign up for our blog there. So you could keep up with us there, and that would make me feel good, getting some impact on some people, even if it doesn't make sense to engage. We're on Facebook, Boyd Wealth Management. I'm on LinkedIn. I'll just look up Boyd Wealth Management on your social media account. You can connect there, or you can always email me, brian@boyd-wealth.com. Love to hear from you.
Perfect. Well, thank you so much, brother. That was really, really fun. I learned a lot. I know everyone else did. So we appreciate you, man.
Thanks for having me on, Norm. I really appreciate it. What a good time this was.
Yeah. Yeah.
Check 1 2, check 1 2, check 1 2.
What's happening, brother?
Good, man. What are you up to? The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referred for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Boyd Wealth Management, LLC, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Boyd Wealth Management, LLC, and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Boyd Wealth Management, LLC, unless a client services agreement is in place. Thank you guys for listening.